Hi, everybody. Robert and Aaron here. This is our condensed version of the One Big Beautiful Bill. We hope this touches on what we think most of our clients would appreciate to know with the One Big Beautiful Bill. We'll go into major changes. There's important provisions here. We have permanent provisions of this bill and temporary act now provisions that we highlight. And then as we wrap this up, we're going to talk about specifics for retirees, families, and some interesting things like these Trump accounts, which are a little confusing, and then planning opportunities that arise out of this, because there are some nuances to this tax bill that could catch some people unaware, especially at various income tax brackets. At the end, we're going to open it up to a Q&A. One Big Beautiful Bill was a major tax rewrite. The last time we did this was the Tax Cut and Jobs Act of 2017. And many of these provisions that are now made permanent were created. They were set to sunset because of budget mechanics. This Big Beautiful Bill was going back and forth, a hot potato, and was signed into law on July 4th. We're excited to present this to you now. We've had some time to digest all of this. We have to hurry on some of these incentives and things that are actually sunsetting in the next few weeks. I'll highlight those for you with the clean energy deductions. We're going to talk about the rates, standard deduction, the SALT cap. There's some interesting nuances there that we want to let our high wages earners know about so they don't fall into a donut hole with the SALT cap, and then the planning opportunities. The things that were made permanent were the tax brackets, the 10, 12, 22, and 24% tax brackets that we were so excited about with the Tax Cut and Jobs Act are now made permanent. The majority of our clients fall into 22 to 32% tax brackets. In 2026, we're excited because that was what was going to happen. For instance, the 22% tax bracket was going to become the 25% tax bracket in 2026 if Congress didn't act. That was one of those cliffs. We're also excited to see that the standard deduction is staying at this elevated level and wasn't going to sunset to the older provisions. It's made a lot of administrative convenience for a number of clients to have the higher standard deduction and not have to track all of their medical receipts and charitable contributions. So this year, starting in 2025, for married filing jointly filers, is going to be $31,500. So they've even increased it more than what the normal inflation adjustment would have been. That is one nice bonus of the One Big Beautiful Bill this year. The child tax credit has been increased to $2,200. We're excited about that for a lot of folks. The refundable portion has also been adjusted, and that's only $1,700 now. But it's nice to see the child tax credit increase. It helps out many folks if you have little ones running around. Some other things that were made permanent here was the estate tax. Most of us mortals, we don't have to worry about being over $15 million in assets at the time we passed. But for those who are, this is good to know that this state exemption is now $15 million. So a married couple really has $30 million they can pass along to their kids through the portability of their estate, what we call the DSUE. We're also excited about the charitable contributions. We were worried that that was going to be adjusted down. We're still looking at this 60% AGI limitation, which is nice. Now it continues to incentivize folks to be very charitable. Something we'll talk on a little bit more here is the SALT cap. This has been made permanent. Back with the Tax Cut and Jobs Act, that was adjusted down to $10,000. And if you're watching the news, a lot of folks in higher tax states, and you can even say Colorado is now with how property taxes have been, were upset on losing some of their itemized deduction for state and local taxes. They have addressed that in this bill. That is now $40,000. For those who itemize, that is welcome relief. But there's an important caveat to this. We want to talk about that donut hole a little bit later. There will be some temporary adjustments. Some of the things that are temporary are the no tax on tips, which is a misnomer, and the no tax on overtime, which is a misnomer. I have to keep presenting it that way because that's what was in the news, and it was on X and Twitter for what these were called. Those are temporary provisions that are going to sunset in 2028, and there are a few others here that we'll touch on as well. I'll talk a little bit more about that, the SALT cap for folks, and a lot of folks will be interested in that. So this SALT cap, it has an interesting phase out. For married couples at $500,000, your SALT deduction is actually going to decrease. down to $10,000 by the time you get to $600,000 of adjusted gross income. So for a lot of folks, we're going to do some creative tax planning around minimizing this donut hole, because really you're going to pick up another $30,000 of income on that next $100,000. So folks are going to actually have a much higher effective tax rate because of this SALT cap phase out. We have some planning ideas that we'll mention at the end for folks that might fall into this donut hole of $500,000 to $600,000 AGI that might be in that phase out. We can be creative with some strategies here to minimize the damage on that. Also, an exciting deduction is we can write off would be a bad term. There is a deduction for interest on your car loans. This is a temporary provision where on American-made vehicles, for folks that have less than $100,000 in income, can write off the interest on the purchase of their vehicle. We're not sure how that is going to be handled. We're not sure if the bank's going to send you a tax document, or if you are in the process of buying an American-made car this year, be really careful on our record keeping. An example on that, your BMW made in Germany is not going to qualify, but your Toyota Camry made in Kentucky would qualify for this. So we really need to look at the origin of the vehicle. For many folks on this call, understanding how the one big bill affects you is really, how does this affect you as a retiree? There was a lot in the news about Social Security not being taxable, so no tax on Social Security. Congress walked that back and they replaced that with the senior deduction. If you're a senior 65 plus, you may not feel like you're a senior, but that is the definition. The taxpayer and spouse each get a $6,000 deduction. The deduction is a reduction of your taxable income. If you are a joint filer, which the majority of our clients are, you have a $12,000 deduction and up to $150,000 of adjusted gross income. Once your adjusted gross income exceeds $150,000, this senior deduction begins to phase out. So every $1,000 of additional income, you lose $100 of this deduction. This could be a good time to strategize with your charitable giving and grouping donations or deductions on your Schedule A. If we think have fluke income from a stock sale or something that bump you over this 150, there should be planning considerations to minimize the damage on this phase out. Charitable giving has had some adjustments starting in 2026. For those who have the standard deduction, they were losing their charitable contribution. Congress has acknowledged that starting in 2026, single filers will get above the line charitable deduction for their donations. In married couples, that goes up to $2,000. Before, if you were just subject to the standard deduction, you did not get any benefit. They're acknowledging that with an above the line deduction starting in 2026 will not be applicable in 2025. So there's some relief there for folks. One of the provisions here are the Trump accounts. This is an interesting vehicle for families, parents, and businesses to help save for children. They've changed the name in the bill from Trump accounts, but everyone's using Trump accounts, and that's the easiest way to think about this. The Trump accounts allow anyone, parents, grandparents, employers, to give up to $5,000 per year per child. This is a limitation per child into this Trump account that's invested in a diversified S&P 500 account. You can imagine that this could be pretty meaningful. Over 18 years, you could grow an account pretty significantly for a child. And to be clear, this isn't that grandma can give $5,000, grandpa can give $5,000 to a child. This is the child in whole can only have $5,000 deposited into their Trump account during the year. So we're waiting for a little bit of guidance on this. Grandma and grandpa are eager to put money in the account now. The IRS is generating provisions on how they're going to set up these accounts for children born in 2025, 2026, 27, and 28. They're automatically get $1,000 set in their account. We know the IRS is going to create those accounts for those children when the parents file their tax return. For everyone who's eager to get going on this now, which you're allowed to if your child's under 18. We are waiting on guidance on how to set up these accounts. It's something that we will circulate in our newsletter once we know more about how to set up the Trump accounts. So this is happening pretty fast. The IRS is a little overwhelmed, as you can imagine, being on their 6th commissioner this year. For 2025 through 28, we are looking at that $1,000 government seed money into the Trump accounts. You ask yourself, how do I get a hold of that money? Whether it's the $1,000 or the $5,000 I put in there. The money is going to be locked up until the child's 18. There's some things you think about if you are funding these accounts. It does become the child's at 18 versus if you had funded a 529 during this period. At a 529, there's some flexibility with the parent to keep some of the funds where the parent is the owner of the account and the child is the beneficiary. You don't have that flexibility here with the 529. So that is something to consider. Also, you cannot change beneficiaries on a Trump account like you can with a 529. If a kid decides to go to not go to college, at least with a 529, you can transfer that money to another beneficiary, your other child who is going to college. We're not going to have that with a Trump account. So those are some long, hard thoughts for family members to have with these Trump accounts. So we're going to talk about some planning opportunities here and some other considerations, especially looking at what is time sensitive that I didn't cover earlier. Our energy credits, solar and EV credits, are expiring here in September. So if you want to get your Tesla, your electric car, your Ford Lightning, those need to be purchased by the end of September or those credits go poof. State credits will still be in place, but the federal EV credits will be gone. Same thing with solar. That is going to be a tough one to get installed here by the deadline. If you are on the bubble on scheduling your solar installs, see about pushing those hard to get done on time so you can take advantage of the solar credits. I think there's quite a bit to talk about here. More on the SALT phase out for folks. This phase out between the 500 and the 600,000, the planning strategies we would like to discuss with folks if they think they're going to fall into that donut hole. Are you maximizing your 401k contributions to bring your income down if you're right on the bubble? If you're self-employed and you're falling into that range, have you talked to Aaron and Robert about setting up a solo 401k and profit sharing plan to help bring down your income so you're not being penalized? If you have a small business, are you taking advantage of the SALT parity deduction that the state of Colorado allows for deducting your state taxes on your S Corp or partnership return? Those are some easy hitting strategies that we can help discuss with you to help reduce your income so that you are not penalized by this SALT phase out between the $500,000 and $600,000 of adjusted gross income. Other considerations still too, now that we know the tax brackets were made permanent, some of the urgency a lot of folks had that were really forcing their Roth conversions and piling them in here into 2025. I'm glad a lot of folks have waited to see how the dust settled with the one big beautiful bill. Now that we know that the 22 and 24% tax brackets are intact, that takes away some of the urgency folks had to do their Roth conversions to help fill up those brackets. If you'd like to discuss with Aaron and myself how Roth conversion strategy might be a good way to save taxes for you in the future, we can talk about that and model that now or a few years from now to see if that is something you're interested in. So we're right at 20 minutes. I don't see any questions. So I have some boilerplated questions that I'm going to go over with everybody and talk for the next few minutes, unless someone wants to chime in. Many of our clients, this is not applicable, but it may be interesting to talk about over coffee with your friends is, what does this no tax on tips mean? And what does this no tax on overtime mean? Because it really is a misnomer. for folks on what no tax on tips, no tax on overtime is, because there actually will be tax on tips and tax on overtime. One of the fun things that people talked about with this no tax on tips, well, it's like, I'm going to tell my employer to tip me at the end of the year because I do such a great job. It's all tip income. In the tax code, they were kind of onto you with that, tongue in cheek. This no tax on tips only applies to folks that it's ordinary and customary in their profession to receive tips. We can think gratuities as in the hospitality would be where this would really fall. This is not my real estate agent. This is not your CPA. This is those customary industries. We see this no tax on tips. How does this work? It's not a tax credit. It's a deduction up to $25,000. A married couple can deduct up to $25,000 of their tipped income. So it's not going to be that you get all your tips tax-free. Things that will still happen here on your tips will still be subject to Social Security and Medicare tax. They'll still be subject to state withholding. We're interested to see how that pans out in 2026 for folks. With this no tax on tips, the IRS is not going to redo folks' W-2s. We're not sure how this is going to be reported, whether we're going to have more information here in box 14 or otherwise for tips to help communicate to us what this looks like. But we're expecting folks to continue to still have their standard federal withholding here, and then looking in 2026 to have the IRS revise the holding tables for these industries that are affected. So that's my segue into talking about no tax on overtime. That's a misnomer as well. If you do have enough income, if you're a married couple, you make over $300,000, your overtime will be taxed. If you're below $300,000 as a married couple, you can have a deduction of your overtime. As I mentioned earlier, we do not know how the IRS or how employers are going to report this. If you do fall into either buckets, the tipped employee or an employee receiving overtime, please keep track of your pay stubs. We're not sure what employers are going to give us, so you can take advantage of this deduction. Just be mindful of that as we come through this year. Employers, if you're in this overtime bucket, are still going to withhold federal taxes, state taxes, Social Security and Medicare. Any over withheld federal income taxes will effectively be refunded to you through this deduction, but there's not necessarily going to be an immediate reduction in your take-home pay. There's just no mechanism for it here in 2025. I hope with some of these withholding tables that will publish in 2026, they can take into account that. So we have more people have more take-home pay, hopefully going forward. I think that would be really good for the economy rather than have this tied up in their tax return. My point here, we have the Roth conversions. Some of the urgency is off on the Roth conversions for folks, especially now that we have solidified tax brackets. Again, there was a lot of pressure with the sunset in 2026 to get as much done as we could. Now, I think we can all take a breath and be much more sane with some of our decision making as it goes there. Want to talk a little bit more about the car loan since no one asked questions. The car loan interest deduction has to be a personal use vehicle. If this is a business use vehicle, we're going to handle it completely differently. You're going to get a deduction on your business return for this, but this does need to be personal use. The vehicles that this qualifies for would be cars, minivans, SUVs, motorcycles, so that Harley Davidson is going to qualify for folks. You can't buy anything over 14,000 pounds. That's where we start to get into those medium and heavy duty trucks. Can't imagine anyone on this call is buying something 14,000 pounds, but that would exclude, say, your RVs and motorhomes. We have another workaround for that. If you are looking at buying an RV, Aaron and I would be happy to talk to you about some things to look for there. We mentioned SALT after 2025. We're going up to $40,000. This is a permanent provision. We're not expecting this to be repealed, but that could be subject to future Congresses and presidents. We'll enjoy it while we can. If we do think it is ever subject to repeal, we'll certainly be hollering from the rooftops about tax planning strategies to take advantage of that. We are excited about it. I did touch on this earlier. Our Trump counts better than this is a personal decision. If you have a financial advisor, I would bounce it off them too. There's some advantages to the Trump accounts and advantages to the 529s accounts. It really depends on your goal for your child and what kind of nest egg you're building. You could certainly do both too. That is absolutely an option for folks. Aaron, do you have a question for me?
Well, something about the salt, it does seem to change pretty frequently. They had 2 years, about 15 years ago, where there was no cap on the salt deduction. So that is one that you see people messing with from time to time.
Aaron, tell me a little bit about the strategy you employ for our small business owners with the salt parity deduction on business returns. How is that
Sure.
advantageous for folks that fall into that donut hole?
Sure. The neat thing that passed a couple of years ago is that at the business level, we are able to pay Colorado taxes for our business income. And so you'll take that deduction at the business level, and then it shows up as a credit on your personal tax return. And so the income still flows through from your business just as it would otherwise. You see this credit for the tax that you were able to pay at the business level and then deduct at the business level. There are some restrictions as far as specified service trader businesses like accounting, doctors, most of the medical field that are limited on that, bloggers of some sorts. But the majority of people who have a business are able to do this. If you're not a specified service trader business and you are going to be subject to that phase out or the donut hole, then you would want to pay your Colorado taxes, at least on your business income, through your business.
Absolutely. It's a wonderful strategy, and we'd be happy to talk to anybody about it. It takes a couple of maybe conversations to wrap your head around it, but we have coached quite a few clients through this tax savings vehicle, especially under the $10,000 SALT cap. Tomorrow, we're going to go over business tax deductions. So we'll talk more about the specified service businesses and why the SALT parity election for Colorado is super important. We're going to talk about changes with the R&D credit and some of the advantages there now for small businesses. They fixed that huge mistake with the Tax Cut and Jobs Act that happened. We're going to talk about bonus depreciation as a consideration for small business owners now that that is made permanent. Everyone that attended tonight, we're going to send out a handout summarizing what we talked about, some of the big provisions here, like kind of consider your quick reference guide. Aaron was kind enough to make that for us.
Thank you so much, everyone.